Welcome. Aware in bot idea. Dumalang, Molo, Sawubona, Hukandet, and a warm welcome to the Induho Knowledge Cast, the podcast, where your curiosity meets insightful conversations. Today, we're diving deep into the world of financial reporting. Now, I know what you're thinking. Accounting standards.
Yeah.
As exciting as watching paint dry, right?
Well, it might not be as thrilling as a Springbok try, but trust me, understanding this stuff, especially IAS 33 earnings per share, can be a game changer for your investment decisions.
Okay, you've piqued my interest. So what exactly is IAS 33 and why should we care? Is this just another one of those complicated things dreamt up by those suit and tie types to confuse us?
Not quite. Think of IAS 33 as the referee in the global financial game. It's an international accounting standard set by the International Accounting Standards Board, the IASB. Their job is to make sure companies around the world calculate and report their earnings per share, or EPS, in a consistent way. This makes it much easier for you to compare companies, say, our very own MTN, with a telecom giant like Verizon in the US.
So it's like ensuring everyone's playing on a level playing field, no matter where they are in the world.
Exactly.
But why is this EPS figure so important?
Imagine you're at a braai and there's a delicious pot of potjikos bubbling away. EPS is like figuring out how much potji each person gets, assuming everyone gets an equal share.
Okay, so it's about understanding how much profit a company is making for each share they have out there.
Spot on. It gives you a quick snapshot of a company's profitability from the perspective of each ordinary share. A higher EPS generally suggests the company is doing well, like a boar whirl overflowing with tasty fillings. But here's the catch. Things aren't always as straightforward as they seem.
There's always a catch, isn't there? Come on, spill the beans. What makes this EPS thing tricky?
Well, a company could have a high EPS not because they're making loads of profit, but because they've been buying back their own shares. This reduces the number of shares outstanding, making the EPS look bigger, even if the actual profit hasn't changed much.
So it's like making the podgy look bigger by taking away some of the bowls.
Sneaky.
Yeah.
Right.
How do we see through this tactic then?
That's where IAS 33 steps in, laying down the law to ensure transparency. It requires companies to disclose these share buybacks so that you, as an investor, can understand what's really driving that EPS figure.
Okay, so IAS 33 helps us separate the real words from the cleverly disguised Viennas. But I heard there are actually two types of EPS, basic and diluted.
What's the difference? Basic EPS is the simplest. We take the company's net earnings and divide it by the average number of shares they had out there during that period. It's a straightforward measure of how much profit each share earned. But sometimes companies have things like convertible bonds or stock options, which are basically promises to issue more shares in the future.
Okay, so those are like potential future guests at our Pachiko's party who might show up and want to share the pot.
Exactly. And that's where diluted EPS comes in. It takes into account those potential future shares and calculates what the EPS would be if all those promises were fulfilled. It gives you a more conservative view, like planning for enough Pachikos just in case everyone shows up.
So basic EPS is like checking the potgy size now, and diluted EPS is like factoring in those extra hungry guests who might arrive later.
Precisely. Diluted EPS helps you understand the potential impact of these future shares on the company's earnings per share, giving you a more realistic view of its earning power.
Got it. So IAS 33 helps us understand both basic and diluted EPS. But what else does this standard cover? Is there more to it than just these calculations?
IAS 33 also deals with things like stock splits and bonus issues. These actions can change the number of shares outstanding, which can mess up your EPS calculations for previous periods. Imagine someone suddenly decided to divide the Pachecos into smaller portions. It looks like you have more Pachecos, but the total amount is still the same. IAS 33 tells you how to handle these changes so you can compare apples to apples, or rather Pachecos to Pachecos, over time.
So it's about ensuring consistency and preventing companies from playing games with their EPS figures.
Exactly. And don't forget the importance of clear presentation and disclosure. IAS 33 sets rules for how companies present their EPS in their financial statements and what specific information they need to reveal about their calculations. It's all about transparency, like making sure everyone knows what ingredients are in the Pachecos.
I'm starting to see why understanding IAS 33 is important.
Yeah.
It helps us decode those EPS figures and make more informed investment decisions.
That's the idea. It's about empowering you, the investor, with the knowledge to navigate the financial world.
Now, we've talked about IAS 33 in general, but let's get into the nitty-gritty. Can you walk us through the actual calculation of basic EPS? Keep it lekker and straightforward, please.
Of course. Remember our Pachecos analogy. Basic EPS is simply the total Pacheco's profit divided by the number of bowls we have. So let's say a company, we'll call it Biltong Bonanza, made a profit of our 20 million last year, and they had 10 million shares outstanding at the beginning of the year. Simple enough so far, right?
Easy peasy.
Yeah.
So we just divide our 20 million by 10 million shares.
Not so fast. What if Biltong Bonanza issued another 2 million shares halfway through the year? We need to account for those extra shares for the time they were outstanding.
Ah, you're right. More shares mean more bowls at our Pacheco's feast, so we need to adjust for that. How do we do that?
We use something called the weighted average number of shares. It sounds complicated, but it's just a way to account for changes in the number of shares throughout the year.
Okay, so we take our starting 10 million shares,
Mm-hmm.
and then we add those extra 2 million shares, but only for the 6 months they were around, like giving those latecomers half a portion of Pacheco's.
You got it. That gives us our weighted average number of shares, and then we can divide our 20 million profit by that number to get our basic EPS.
All right, that makes sense. So basic EPS is all about dividing the total profit by the weighted average number of shares. Got it. But what about those tricky situations where companies issue more shares during the year, but then buy some back? How do we handle that in our calculation?
That's where things get a little more interesting. Let's say Biltong Bonanza, after issuing those 2 million shares, decided to buy back 1 million shares towards the end of the year. It's that they realized they might have overestimated the appetite of their guests.
So now we need to subtract those shares that were bought back from our weighted average calculation, right?
Exactly. We need to adjust for the time those shares were no longer outstanding. Think of it like removing some bowls from the table before serving the Pachecos.
So we take our starting shares, add the new shares for the time they were around, and then subtract those bought back shares for the time they were gone. Then we divide our profit by that final weighted average number.
You've got it. It ensures we get an accurate picture of the earnings per share, accounting for all the share shenanigans throughout the year.
Okay, I think I'm starting to grasp this basic EPS thing, but I'm a bit nervous about diluted EPS. It sounds like it could be a real headache.
Don't worry, it's not as scary as it sounds. We'll break it down step by step in part 2, making sure you understand how to calculate it and what it really means for your investment decisions.
Excellent. Stay tuned, folks, because in part 2, we'll be delving into the world of diluted EPS, those chameleon-like convertible securities, and those sneaky stock options. We'll make sure you can spot any accounting tricks and make informed decisions, just like a seasoned investor at the JSE.
Welcome back to the Indubo Knowledge Cast, where we're demystifying the world of financial reporting, one Bry analogy at a time.
That's right. Last time we tackled basic EPS.
We did? Figuring out how much profit a company makes for each share.
Like
dividing a pot of Pacheco's amongst a group of hungry guests.
But you mentioned something about diluted EPS,
Right.
which sounded a bit more complicated, like those extra guests who might show up unexpectedly and want to share the pot.
That's a great way to put it. Diluted EPS is all about factoring in those potential future shares that could dilute the earnings per share, just like those extra mouths to feed at our Pacheco's gathering.
Okay, I'm ready to face those extra guests.
Yeah.
What exactly are these potential future shares, and where do they come from?
They come in various forms, like those chameleon-like convertible securities we mentioned earlier. These are financial instruments that can transform into shares, potentially increasing the number of shares outstanding and shrinking that slice of earnings per share.
So they're kind of like those 2-in-1 combo meals you get at the Engen garage, a borer's roll that magically transforms into a slap chip.
That's a very South African analogy. But yes, in essence, they offer the holder the flexibility to choose between different forms of investment depending on what's more advantageous at the time.
Okay, so convertible securities are one type of potential future share. What are some others?
Another common one is warrants. These give the holder the right, but not the obligation to buy shares at a specific price within a certain time frame. Think of it like having a rain check for a Bry. You can use it if it rains, but if the weather's lekker, you can just skip it.
So if the share price goes up and it's a good deal, the warrant holder can exercise their right and buy those shares.
Exactly. And if the share price stays low, they can just let the warrant expire. No harm, no foul.
Got it. So convertible securities and warrants. Anything else lurking in the South African financial bushveld?
Employee stock options are another big one. These are often given to employees as part of their compensation package, giving them the right to buy company shares at a certain price. It's like getting a discount voucher for your favorite shop. But in this case, the shop is the company you work for.
Ah, so if the company does well and the share price goes up, those employee stock options become valuable. But if the company struggles, they're not worth much.
Precisely. It can be a great incentive for employees to work hard and help the company succeed.
Right, so we've got convertible securities warrants and employee stock options. All of these can potentially increase the number of shares outstanding, diluting those earnings per share. But how do we actually calculate diluted EPS? Is it just a guessing game?
Not quite. It involves a bit more number crunching than basic EPS. But the principle is the same. We still start with the company's net earnings, but now we need to adjust both the numerator and the denominator to account for those potential future shares.
Okay, walk me through it. How do we adjust the numerator?
Remember those convertible bonds we talked about? They usually come with interest payments. If those bonds were converted into shares, those interest expenses would disappear.
Poof. Like load shedding during a crucial rugby match.
Exactly. So to adjust the numerator, we add back those interest expenses that would vanish if the conversion happened.
Okay, that makes sense. So we're basically saying, what would the earnings look like if those bonds were already converted into shares? What about the denominator? How do we adjust that?
For the denominator, we add the number of shares that would be issued if all those potential shares, like the convertible bonds warrants and employee stock options, were converted. It's like expanding the Potjico's pot to accommodate all those extra hungry guests.
So we're basically creating a hypothetical scenario saying, what would the EPS be if all these potential shares became actual shares?
That's precisely it. Diluted EPS gives us a more conservative view, showing us the potential impact of those future shares on the earnings per share.
It's like planning for the worst-case scenario at our Potjico's gathering, making sure we have enough to feed everyone, even those unexpected latecomers.
Exactly. Now let's bring it back to the South African context. What are some things our listeners should keep in mind when analyzing diluted EPS for companies listed on the JSE?
All right, give us the lowdown on those JSE-listed companies. What should we be watching out for?
Firstly, pay attention to the company's capital structure. Do they have a lot of convertible debt or warrants outstanding? If so, their diluted EPS might be significantly lower than their basic EPS, indicating a greater potential for dilution. It's like checking the foundation of a house. If it's built on shaky ground, it might not be as sturdy as it appears.
So a big difference between basic and diluted EPS could be a red flag suggesting that those future shares could significantly dilute the earnings.
Exactly. Another crucial factor is the likelihood that those potential shares will actually be converted or exercised. If the conversion or exercise price is far out of the money, the dilution might not be as significant in the near term. It's like that rain check for a braai. If the weather's looking sunny for the foreseeable future, we're probably not going to need it anytime soon.
Right, so we need to consider both the quantity and the timing of those potential future shares. If those convertible bonds are deeply out of the money, they're probably not going to dilute the earnings anytime soon.
Precisely. And don't forget those employee stock options. Companies might grant a large number of options with very favorable exercise prices, potentially leading to significant dilution down the road.
So it's like offering everyone at the braai an extra helping of borrowers, even though there's only so much to go around.
That's a great analogy. Investors need to assess the potential dilutive impact of those stock option plans and factor that into their analysis.
Now let's get a bit more cynical. We know companies can be sneaky sometimes. Are there any tricks they might use to manipulate their diluted EPS? Spill the tea.
Oh, there are always those who try to bend the rules. One common tactic is to structure convertible securities in a way that minimizes their dilutive impact. They might set a very high conversion price, for example, making it less likely that those securities will be converted into shares.
So they're trying to make those convertible bonds look less like chameleons and more like sturdy tortoises, less likely to change their appearance.
That's a good way to put it. They're trying to downplay the potential for dilution, but savvy investors like you can see through these tactics by carefully scrutinizing the terms of those convertible securities.
It's about reading the fine print, just like when you're signing a contract for a new backy.
Exactly. Another trick is to delay the issuance of potentially dilutive securities until after the reporting period so they don't show up in the diluted EPS calculation.
Oh, it's like hiding the mess in the cupboard before the guests arrive for a braai, out of sight, out of mind.
Sneaky, right? But remember, IAS 33 requires companies to disclose those potential share transactions that occur after the reporting period, but could significantly impact the EPS.
So we need to check those disclosures, just like making sure there are no unwelcome surprises hiding in the boot of that new backy.
Exactly. Transparency is key, and savvy investors like our listeners know to look beyond those headline EPS figures.
All right, so we've tackled basic EPS and dived deep into diluted EPS. What's next on our Endubo KnowledgeCast adventure?
In Part 3, we'll explore how IAS 33 plays out in the unique landscape of South Africa. We'll uncover how factors like load shedding, the fluctuating exchange rate, and BEE can influence a company's EPS.
Sounds like we're adding some extra spice to our EPS pachecos and fusing it with those uniquely South African flavors.
We'll be back soon, so stay tuned.
Welcome back to the Endubo KnowledgeCast for the final part of our deep dive into IAS 33 earnings per share.
We've covered a lot of ground, haven't we? From basic EPS to those sneaky diluted earnings, we've explored how to decode those EPS figures and make sense of a company's profitability.
We've even brought a few analogies along the way, comparing EPS to everything from Pacheco's portions to Borwer's rolls.
Now in this final part, we're bringing it all home, exploring how IAS 33 plays out in the unique context of South Africa.
It's like adding a dash of chakalaka to our EPS bunny chow, giving it that distinctive South African flavor.
We'll unpack how factors like load shedding, the volatile exchange rate, and BEE initiatives can all influence a company's EPS and ultimately your investment decisions.
Okay, let's tackle those uniquely South African challenges, starting with the elephant in the room, or maybe the rhino in the bushveld. Load shedding.
Load shedding is a major headache for businesses in South Africa. It disrupts operations, increases costs, and can even scare away customers. Imagine trying to run a restaurant with only a few hours of electricity a day. Talk about a recipe for disaster.
It's like trying to braise a steak in the dark.
Yeah.
You might eventually get it cooked, but it's going to be a lot more challenging and probably not as tasty.
Exactly. These disruptions can hit a company's bottom line, potentially shrinking their profits and impacting their EPS. So as investors, we need to consider how well companies are managing this load shedding challenge.
So it's not just about looking at the EPS figures in isolation, but also understanding how resilient a company is to these power cuts.
Precisely. Are they investing in backup power solutions like generators or solar panels? Are they finding creative ways to minimize disruptions, like adjusting their operating hours or shifting production to off-peak times?
Those companies that are proactive and adaptable are more likely to weather the load shedding storm and maintain a healthy EPS, even when the lights go out.
It's like having a plan B, a backup generator for your bride, just in case Eskom decides to play games.
Now, let's talk about another South African roller coaster. The fluctuating exchange rate. The rand can be as unpredictable as a taxi driver in rush hour traffic. 1 minute it's up, the next it's down. How does this volatility impact a company's EPS?
For companies that import or export goods, a volatile exchange rate can be a real headache. If the rand weakens, it can make their exports cheaper and more competitive overseas. But it can also push up the cost of imported components, squeezing their profit margins.
It's like trying to balance a scale. A weaker rand can tip the scales in favor of exports, but it can also make those imported ingredients more expensive, creating a financial balancing act.
Exactly, and this balancing act plays out in a company's EPS figures. So investors need to understand how exposed a company is to these currency fluctuations.
So if a company relies heavily on imported goods, a weaker rand could eat into their profits and potentially dent their EPS. But if they export a lot, a weaker rand could actually boost their earnings.
It's all about understanding the dynamics of each company and how they're positioned to manage these currency swings. Are they hedging their currency exposure? Are they diversifying their supply chains to reduce their reliance on imports? These are all important questions to consider.
Right, it's about looking beyond those headline EPS figures and understanding the underlying factors that are driving those earnings.
Now let's move on to another key aspect of the South African business landscape, Black Economic Empowerment, or BE.
BE is a crucial part of our economic transformation journey. But how does it factor into the EPS equation, and what should investors be aware of?
BE initiatives can take various forms, from ownership structures and management control to skills development programs and preferential procurement policies. And these initiatives can impact a company's costs, their revenue streams, and ultimately their EPS.
So a company with a strong BEE scorecard might attract more business from government or other corporates that prioritize BE compliance. That increased business could lead to higher revenue and ultimately a boost to their EPS.
That's right. On the other hand, some BE initiatives might involve upfront costs, such as investing in skills development programs or enterprise development initiatives. These costs could potentially impact a company's EPS in the short term.
So it's a balancing act, weighing the long-term benefits of BE compliance against any potential short-term costs. Investors need to consider a company's BE strategy and how it might impact their financial performance both now and in the future.
Exactly. It's all part of understanding the company's story, their commitment to transformation, and how that might translate into sustainable growth and earnings.
Now that we've explored these uniquely South African factors, what are some key takeaways for our listeners? What EPS wisdom can they take away from this deep dive?
Firstly, remember that EPS is just one piece of the puzzle. It's a useful metric, but it doesn't tell the whole story. Don't rely on it in isolation, but consider it alongside other financial metrics like return on equity, debt-to-equity ratio, and cash flow. And don't forget those qualitative factors such as the quality of the management team, the company's competitive landscape, and their overall growth strategy.
It's like judging a rugby player solely on the number of tries they score. You need to see their teamwork, their defense, their overall contribution to the game. ETS is just one data point in a much bigger picture.
Exactly. Another important takeaway, don't be afraid to dig deeper. Read the company's financial statements, especially the notes, where they break down their EPS calculations and disclose any unusual items that might be impacting the numbers. It's like checking the ingredients list on a food label. You want to know what's really going into that EPS figure, not just the headline number?
Transparency is key. And finally, remember that the accounting world is constantly evolving. New standards are introduced, old ones are updated, and companies are always finding creative ways to present their financial performance.
So stay curious, keep learning, and never stop asking questions. The more you understand about financial reporting, the better equipped you'll be to make informed investment decisions.
That's it for our deep dive into IAS 33 earnings per share. We've covered a lot of ground from the basics to the nuances and explored how this accounting standard plays out in the unique context of South Africa.
We hope you found this insightful and, dare we say, even a little bit entertaining. Remember, knowledge is power, especially when it comes to your hard-earned money.
Until next time, stay informed, stay curious, and happy investing South Africa.